Now in part two, we're going to go deeper into the specific refined products and really what's moving those. And we normally really kind of focus on at this point the gasoline, distillate, and jet fuel components. And as we start going through, we'll start increasing and looking at LPG, propane, and really things that are moving the market at this point. But these are some key aspects in terms of where things sit at this point in time. And here you can see just looking at the product supplied. So this is taking the data and then taking that average, because again, the averages constantly go back and forth. So here you can see, even though we had a big increase in that weekly demand, which was really driven across the board, as we'll look at in a second. But the bigger piece is going to be, how does this look like on the average? And this is something that we're going to see a normalization to the downside, and really just keeping that 2020 average kind of in line, especially as if you look at just where 2019, 2017, 2018 are, we always have that natural drop as we go through that shoulder season. So just jumping right in, distillate remains a problem. We had another build of about 1.4 million barrels. And this is going to be problematic as we continue to go through the remainder of the year, because we remain at near all-time highs, or at least highs going back to the 1980s. So the issue is going to be, how do we clear this glut? And with distillate sitting here like this, there just seems to be a very limited amount of options to get this into the market to clear up where the options are. And then this also leads into jet fuel, because we've seen additional commentary from different airlines about additional furloughs, a cut in the amount of expected new flights. So then the question is going to be, well, where does the jet fuel go? Does it get dumped back into the distillate cut? Well, distillate remains at all-time highs, so that's going to be difficult. Is it going to be blended into gasoline? Well, there's a little bit more optionality. So this is going to be an interesting debate to see, where does some of this additional jet fuel go, especially with distillate so high. So now as we look at just, again, that demand, we've been saying that distillate is going to stay at the 5-year average. There's nothing to say it's not going to fall back, especially as we go into the Hurricane Laura, which is going to impact demand across a broad swath of regions, especially if it moves as quickly as it's supposed to, where we're supposed to get rain in New York once it gets caught up into the jet stream. Saturday, Sunday. So you're going to see kind of that impact all the way through, which again is just something that's going to impact these types of numbers, but not enough to really shake anything past that 5-year average. And again, just kind of breaking it down into pieces, we see some of the shipping benefits. There's been a shipping increase. Again, we're still well off of year-over-year normalities, which is something we're going to talk about in the economy show. But the one that we really want to look at, again, is that rail. Rail has been holding that 15.9% down versus 2019. You're starting to see a shift in grains that will continue, especially as we head straight into harvest season and we continue to see exports increase, just as there's those grain shortages, specifically in Asia, which will be a positive because you'll see those hopper cars getting utilized. But again, we continue to see the issues, really resonating through the remainder of the year, specifically across not only just total traffic but across just the total car loads. One of the benefits that we're starting to see a little bit of a creep higher in is that intermodal. So the intermodal is starting to see a little bit of an adjustment. This week we had a little bit of an increase, and you're starting to see some of that pull through with not only an increase in consumer goods, which is something we'll also talk about in the Econ show, but an increase in the amount of housing starts, new home builds. So these are things that you're going to start to see some of those intermodal cargoes really start moving things into it. But again, there's going to be too much of an overhang. And so even though we're going to get these little small pockets of benefits, it's not going to be enough, which is, again, going to weigh on total distillate demand. Now, trucks, again, won't stop, can't stop, won't stop. And here they are again. They're hitting a new all-time high. And now if you look at just total demand, it's now well above the 2018 levels. And again, it's just because there is so much capacity out there. So even though there's that huge demand, there's more than enough trucks to meet that. But again, we're starting to see that absorption, which is continuing to pull those rates higher. Again, it's not going to be as high as 2018. purely because of diesel. Diesel prices remain low, remain suppressed, and that's a clean pass through. But just because we are starting to see even that spare capacity get absorbed, those rates continue to pull higher. So this is a good thing if you consider just road fuel. So again, those are those two different sides where trucking remains a bright spot while that rail and shipping remains that overhang, which is why we're pretty confident that we're going to stay within that 5-year average. The question is going to be, does the trucking continue as we start to see a little bit of a normalization with jobs, remaining scarce in terms of just new jobs, spending starting to normalize a bit, back to school spending starting to adjust. So we would expect this to start to roll over, but again, it could continue to go for another week or two, which will be inherently positive. But there should be a small decline just because obviously the hurricane, but also that hurricane is going to mean that you're going to have to backfill. You're going to see more stuff. So we could see a decent amount of support, even though we have some of those overhangs with the economic data, just because of the sheer weather impact. Now that leads us directly into gasoline. So the issue is going to be in terms of where is gasoline at this point as we go forward. Again, we had a draw of about 4.6 million barrels, which is another positive. Imports were down. Imports were down again, which will be a problem as we start going into the next month. And now imports were down. They'll stay down through August, because there weren't a lot of tankers that were booked. They started to book new tankers last week when Colonial went down. But now with the weather surge, you're starting to see a rush to pick up new tankers. So as of this morning, another 10 tankers were booked to load about 370,000 tons by the end of this month. Now, if they're loaded by the end of this month, given there's a time delay because you have to get it from from across the Atlantic into Pad 1. So again, those are those timing delays, but we will get a surge of imports that will start to hit throughout September. Now, if things change and there's a big shift, then those could get resold or just hang out in the water. But right now, it looks like, just given the fact that we've had gasoline draws in Pad 1, that brings us closer to, we're actually now down last year, and we're down a little bit versus that 5-year average. So there will be capacity to take in some of that gasoline. So I don't see it sitting out there. It should get passed right through, and we'll see more of them getting moved into the U.S. market as that arbitrage opens, because we have seen prices increase, and due to Hurricane Laura, we could see another increase in pricing, which again will just help that ARB and pull more from Europe into our market. So right now, there should be about an additional 8 tankers, about 296,000 tons in early September so far, which is again that's going to be that increase that we should continue to see run through the market. Now, it's important to understand again the way the data is essentially put together through the EIA versus some of this gas buddy, which is more at the retail side. So when we look at last week, we actually saw a decline of 1.36% week over week, with Thursday seeing the largest decline of about 4.16% versus the week prior. Now, again, this is all timing, and that's why I continue to stress the 4-week average, looking at things holistically and using multiple data sets, because we see these adjustments on a regular basis in terms of when are the barrels calculated. Now, given there's a prep for Labor Day, these numbers don't reflect Labor Day yet. So this is something where we should see a big increase week over week. And then it's going to be more important of what is it year over year to kind of compare apples to apples versus Labor Day. So we should see a normalization in terms of gasoline demand coming down this week and next week, even though we should see an increase in total demand of gasoline week over week when we're looking at it on Labor Day weekend. Now, the interesting thing is going to be how much impact are we going to see on gasoline demand, because some of these areas are some high driving regions. And if we remember back to Harvey, because it paused over the area, it dumped a significant amount of water, really hindered a large a large area just because it gets swirling over the area, dumping and hindering a lot of that driving. So it'll be interesting to see how this impacts. Right now, it shouldn't be too meaningful, just given, again, the speed in which it goes through, but it's going to cause damage, winds, roads, trees, flooding. So those will be things to watch as we start looking at the retail side as well. And this is where we see the EIA data. So you see we're just south of the low end of those numbers, which we'll talk about in a minute when we break out that cloud. But again, it's a nice pop. It's something that we're now at 9.2 million barrels, 9.16 million barrels of demand. But again, it's the preparation that we normally see. We normally see that spike. If you look at the 5-year average, which is that dotted line, you can see the spike, and then we start to normalize and come down as we go through shoulder season, as there's that prep for the Labor Day weekend. So this is something to watch, which is why when we look at it on the normalized level, we wanted to see, okay, well, how much damage did we see because of Harvey? So you saw that big increase prior to Harvey, and then we had that drop off, and we should see something similar just in terms of the drop off. But again, it's going to be how significant is the flooding within the region and how quickly does it move out of the area. But the low that we saw in that 5-year average was 2015. But we can see, again, the trend remains to the downside. So it's just a matter of looking at all of the mobility data, some of those important highlights that we always look at which we'll talk about in a minute. Now, just to round it out, is jet fuel. We talked about how we're kind of here in this comfort zone of let's call it about 960,000 to about 1.1 million. And here we are. There's really not much to talk about. The question is going to be, how much do we see over time if we start to see the infection rates come down? If we don't see what I think some are expecting in terms of a surge in the fall and winter, could you see some of this come back to normal? And just given where costs are and prices are at on the corporate side, it's unlikely to see a huge amount of corporate travel. And as we start getting into some of that TSA data, you can see that we normally kind of get that drop off. And so as we look at the TSA data, you can see that as we get into the shoulder season, as we come into fall and winter, we normally kind of get that things slowing down and dropping off as people start to stay home. Kids go back to school. The ability to take vacations becomes a little difficult. And when you look at it, when we're looking at at this year, we just remain in that confidence level. So we did make a new low versus the previous weeks, but again, we're supposed to. When you look at it, when you look at it compared to last year, we should be making that new low. And again, it just comes back down to that back to school. People kind of getting back into the habits and the normal school year begins, or some normalcy, or hopeful for normalcy, which is again something we'll talk about in the economy show. But the Google mobility data, again, there's really not much to change. We're looking at this on the 7-day rolling average. We had that bump in June as things started to get a little bit better. Then we had that lockdown. And now we haven't really seen many things adjust in any real way. Parks will start to come down as we start to see back to school. But the bigger issue is going to be that transit stations. And workplace, are we starting to see any of that kind of come back as kids go back to school and work from home starts to alleviate? And it just doesn't look like we're going to see any of that in the near term. And then that's going to go into that longer term view of, as people move out of urban, as people go more into the suburban area, will we inherently get more driving, and we'll actually see a resurgence in gasoline demands, which are things that we're going to discuss over the coming months. And then just back to the open table data. Now, open table, we've seen another increase, which is nice to see as we start to see some of this normalization. Florida is talking about having in dining beginning on Monday, so we'll see the U.S. get a little bit better. We're seeing a little bit of a concern in terms of Italy and Spain and France when we're looking at new cases. So you might see some of that come back. But again, it's where the trajectory is in the right direction. We should see another increase as we go through some of the data. And then when we break it out, just looking at open table, on a global level, we've been between this 40-45% over the last week or two. The real drivers, the U.S. has been between that 55%. We should see the U.S. get better, though, and we should see the U.S. get something closer to only down 45%. The bigger issue, the bigger benefit, I should say, when we're looking at the globe, has really been Germany, Ireland, and the U.K. in terms of those movements higher. Now, Germany and Ireland should maintain. The UK is a little bit of a friction point in terms of how much is coming back, how much isn't coming back. There will be a little bit of an overhang as we start to look at some of these other areas when we think about how these shifts are. But again, Germany remains a bright spot because even though we had an increase in COVID cases in Berlin, we didn't see it spread. We saw it relatively localized, and we didn't see an impact in terms of the open table and restaurant bookings, which is, again, something positive to see. We will see that increase in the U.S. as Florida, California, Texas, things start to normalize a bit. Obviously, hurricanes will impact that short term, but the trend is in the right direction, especially when we start factoring in Florida, which will help some of this underlying data. But as we start going into that normal or the back to school mentality, we will see some of that. It'll be important to understand the mobility data and how that's going to impact gasoline and diesel as we start going through the remainder of the year, just as COVID continues to do different things. And then we really want to look at what does that mean for the export market, as we talked about how that's going to impact our import market, which is where we're going to go in part 3.